Welcome to our channel. Have you been wondering how to make sense of the inflation figures in the US of late? If your answer is yes, you've come to the right place. We have two objectives in this video. First, we'll explain the reasons behind the sharp rise and fall in US inflation. And second, we address the question as to what the future holds for US inflation. So let's dive in. Basic economics teaches us inflation can either be due to demand pull factors or cost push factors, or a combination of both. For today's discussion, we'll focus on demand pull factors. This is when there is too much demand for goods and service compared to their supply, leading to higher prices for these items. Conversely, when supply outstrips demand, prices tend to fall. Let's look at how the US inflation cycle has behaved since 2000. Outside of the global financial crisis in 2008, inflation has remained relatively stable, averaging 3% year-on-year before the global financial crisis period. Post the global financial crisis, the rate averaged 2% year-on-year. However, in mid-2021, things took a surprising turn. U.S. inflation started accelerating and skyrocketed to a peak of 8.9% in June 2022. This caught many policymakers and commentators by surprise. Since then, it has moderated to 3% in June of this year. To understand these inflationary trends from a supply and demand perspective, let's analyze data from the U.S. Federal Reserve. We use U.S. industrial production of consumer goods as a proxy for supply and U.S. consumption of consumer goods as a proxy for demand. Take a look at this chart. It shows the growth of U.S. supply and demand of consumer goods since 2003. Viewers will note both the supply and demand of consumer goods contracted sharply only during two periods, which is during the global financial crisis in 2008 and the global pandemic in 2020. But here is the eye-opener. During the entire period since 2003, U.S. demand for consumer goods has traditionally expanded at a faster pace than supply. Demand usually expanded by an average 5% year-on-year, while supply expanded by a slower average of 2% year-on-year. Put simply, demand has been expanding at more than twice the rate of supply in the U.S. economy. Due to this difference, this puts upward but moderate pressure on U.S. inflation. Fast forward to 2021, the chart clearly shows a dramatic acceleration in both the supply and demand. At its peak, the supply of consumer goods reached a record expansion rate of 21% year-on-year in April 2021. From the demand side, the rate of expansion was even more stunning, reaching over 38% year-on-year. The resultant gap is best illustrated in this chart, which is simply the differential between the supply and demand of consumer goods in the U.S. economy. While the differential usually ranged between 2% to 5% between 2003 to 2019, it reached an astonishing 20% in April 2021. So what triggered this abnormal gap? In our view, this gap occurred because of two key simultaneous developments, which impacted the demand and supply of consumer goods. On the demand side, the U.S. government essentially created a consumer boom by pumping over $6 trillion through its various stimulus acts during the pandemic. This is equivalent to 30% of annual GDP. At the same time, on the supply side, there was widespread factory and port lockdowns across Asia, particularly in China due to public health restrictions. Viewers should note that China is the main source of U.S. consumer imports ranging from textiles, toys, to consumer electronics. These lockdowns meant truck drivers and ship crews could not cross borders, leading to massive disruptions in the global supply chain. This ultimately led to a surge in global freight charges. According to data from the U.S. Federal Reserve, which tracks a composite global supply chain pressure index, the lockdown resulted in a sharp and significant rise, peaking at 4.3 standard deviations above its historical mean in December 2021. Such a combination inevitably led to a sharp increase in prices. So, going forward, where will U.S. inflation be heading based on this simple supply-demand perspective? With the easing of lockdown measures in China and, more importantly, the end of the U.S. government's stimulus package, the supply and demand gap in the U.S. is now normalizing. This view suggests the downtrend in U.S. inflation is likely to continue. However, keep in mind that the rise and fall of inflation cannot be solely attributed to just supply and demand imbalances. There are, of course, other factors at play. This includes the threat of rising food and oil prices on the back of yet-to-be-resolved tensions between Russia and the U.S. over the war in Ukraine. These factors are potentially capable of reversing the downtrend in U.S. inflation and, as such, deserve a separate video sometime in the future. Overall, the main purpose of this video is to show our viewers that a good starting point to understanding inflationary pressures in the U.S. is to examine the demand and supply imbalances created during the pandemic and the government's strategic policy responses. We hope this data-driven analysis has given you valuable insights. If you found this video helpful, give it a thumbs up and share it with others interested in understanding global economic and financial developments. For our subscribers, we'll provide the statistical sources for all the charts you see in this video, so be sure to hit that subscribe button. As always, don't forget to leave your questions and comments below. See you in our next video.